Our last two topics will cover capital budgeting and cost of capital. Capital budgeting is chapter 5 and chapter 6 of your textbook. So let's just quickly go over the content of your textbook. So chapter 5 is all about net present value and other investment criteria. Because when a company engages in a long-term project, which is called a capital budgeting project, there has to be some decision rules in order to determine whether a project is feasible or acceptable or not. From a financial perspective, one criteria that's chosen is what we call the net present value, which we have discussed in passing before. And the rule is that when a project has a positive net present value, that project is said to be feasible. But however, if it's a negative NPV, then that project is said to be not feasible and it has to be rejected. So in this topic, we're going to look at how we assess capital projects. So let's just take a look at quickly the content. So the net present value is simply computed by getting the present values of your cash flows. Okay, so of course, you have to determine what the cash flows are. You cannot have any net present value if you don't know the cash flows. Okay, so in this example, before we have an example, here you have what CFOs, Chief Financial Officers, use in evaluating projects. And we notice that almost tied is 76% IRR and 75% NPV. So both are very popular. These two methods are very popular among CFOs. But it's surprising that 76% chose IRR, 75% NPV. There are advantages and disadvantages of using any of the two, but the others are, you have profitability index, you have the payback period, you have the rate of return. So the payback period comes in next at 57%. Attendance mamaya na lang, ha? Okay, so here we have some points to remember here. Okay, so we're just going through this very quickly, guys. It's your responsibility to read through this. Some 3 points to remember about the net present value. So the NPV recognizes the time value of money, that a peso today is worth more than a peso tomorrow. Okay, because we know of the cost of money, you can invest that peso today and it will earn an interest so that its value the following day should be more than a peso, the peso today. So any investment rule that does not recognize the time value of money cannot be sensible. Okay, so we have discussed that even in the first few weeks of this subject, that's a fundamental principle in finance, the time value of money. Okay, second, net present value depends solely on forecasted cash flows, okay, from the project and the opportunity cost of capital, or what we call the weighted average cost of capital. Okay, so when we compute for the net present values, we have to forecast. We have to forecast the cash flows that go with the project. Notice that the term cash flows is used. We're not evaluating the net income after tax. What is evaluated are cash flows. So what happens is that this cash, when you compute for the net income after tax, they're converted into cash flows, and then the cash flows are the values that are evaluated if based on net present values. Okay, third, because present values are all measured in today's pesos, you can add them up. Okay, so for example, the net present value of projects A plus B is simply equal to the net present value of A plus the net present value of B. Okay, so that's another fundamental principle in finance. If the net present value of project A is 10 and the net present value of project B is 20, then those two can be added to have a total net present value equal to 30. Okay, so those are simple principles in as far as net present value is concerned. Now the book, this is the accounting rate of return. It's just the net income divided by the total assets used for that investments. So we will not place so much focus on this, because this measure does not take into consideration the time value of money. Okay, so this is not used so much because it violates the principle of the time value of money. Payback period, guys, tells us how long will it take us to recover the initial investment. So for example, if you have this project, for project A, you have an initial investment of 2,000, and then the cash flows is for the first year 500, for the second year 500, for the third year 5,000. Then it will take the company more than 2 years to recover the initial investment. That the number of years it takes the company to recover the initial investment is called the payback period. Okay, there's another kind of payback period which is called the discounted payback period. Okay, this one. And the difference between the payback period and the discounted payback period is that in the discounted payback period, what you use to compute for the payback period is the discounted cash flows, which means we use the present value of the cash flows. Okay, we'll have an example of that in a while. Okay, in the meantime, guys, may I request you to download the Excel file that I posted in Canvas. So that's capital budgeting, and kindly download the Excel file there. Okay, so aside from the accounting rate of return, the payback period, we also have the IRR. Okay, this is another measure which we said was very popular among CFOs. So you have the internal rate of return. Okay, so just like the discounted payback period, the IRR method also makes use of the time value of money. So the discounted payback period and the IRR are acceptable methods in evaluating projects. The payback period, guys, is not. Okay, because the payback period does not take into consideration the time value of money. But the discounted payback period does make use of the time value of money. So the process by which IRR is computed is by trial and error. So, but in our case, since we have Excel, we can easily compute for IRR, and we need not go through the process of elimination or iteration. Okay, and what's important to note is that the IRR is that rate of return. As you can see here, the IRR is that rate of return where your NPV is equal to 0. Okay, let me repeat that. The IRR is that rate of return where the net present value is equal to 0. Okay, so what's the decision rule about IRR? The decision rule about IRR is that, take a look at this project, at this plot. So here the IRR is 28.08. So the discount rate is on the x-axis, the net present value is on the y-axis. So what does this tell us, guys? How do we decide if a project is acceptable based on IRR? You decide whether a project is acceptable based on IRR if the weighted average cost of capital or the opportunity cost of capital is less than your IRR. Okay, take a look at this plot. If the cost of capital is less than 28.08, then you have this portion where the net present value is positive. Okay, to the left of 28.08, okay, which means that the discount rate is less than 28.08%, the net present value is positive. To the right of 28.08 here, in this portion, you have the net present value being it's negative. Okay, at 28.08, the net present value is equal to 0. So we are indifferent, guys, if the IRR is 28.08. We are indifferent whether to accept the project or not. Okay, if the cost of capital is 28.08 and it's equal to the IRR, then whether push through with the project or not, we will be indifferent to that because anyway the net present value is equal to 0. So when is a project feasible? A project is feasible if and only if the cost of capital is less than the IRR. Or in other words, IRR should be greater than the weighted average cost of capital. If the weighted average cost of capital, for example, in this case is 40, then that will mean that our net present value is negative. Okay, and we can only accept projects if the net present value is positive. Okay, so that's the IRR rule. Okay, there are instances when a project may have several multiple IRRs, and that happens when you have negative cash flows in the middle of the project or at the end of the project. For sure, guys, definitely at the beginning of the project, you'll have a negative cash flow. Why negative cash flow? Because that's the time when you put out money for the investment. But when you have another negative cash flow, okay, in the middle of the project or at the end of the project, then there's a chance that there will be multiple IRRs. Okay, in this case, take a look. So this is a diagram of the IRR for this project where you have another negative free cash flow at C10. Okay, that's negative 65. Okay, at year 10, you have a negative free cash flow. So when you plot that, you will see that there are two IRRs. Okay, so when a project has cash flows that's negative at not only at year 0 but at a time after year 0, then most probably that will have a negative 2 IRRs. Okay, so as mentioned before, there are two types of project. We have mutually exclusive project and independent projects. Okay, when projects are mutually exclusive, it means that you can only choose one project. Okay, the choice of one project will exclude the other one. On the other hand, the other type is independent. So for independent projects, you can choose more than one of the projects. It will only depend on the available budget or the available funds for the projects, for the different projects. Okay, and this one, guys, this is what we call the crossover, which we'll discuss in a while. Now, what we do here is that we plot two projects, okay, project F and project G, and then we determine when do we choose project F, and then when do we choose project G. In this case, you can see that here, when the cost of capital is at this point, exactly where they intersect, then we are indifferent to choosing project F or project G. It doesn't matter if you choose project F or project G. But when the cost of capital is less than this point, okay, it's less than this point, which we call the crossover rate, then we choose project G. Take a look at the plot here. Project G is the brown one. And to the left of this point, which is the crossover point, project G has higher NPV compared to project F. But to the right of this point, whatever this point is, you notice that project F has a higher NPV than project G. Okay, so both of them are, so we choose project F, okay, if the cost of capital is to the right. Okay, now, and then when the cost of capital is between 25% and 36.83%, of course, definitely we choose project F. Okay, we choose project F because project F is the NPV of project F is greater than that of project G. Okay, beyond 36.3%, we reject both projects. Okay, so beyond 25%, we reject project G. Beyond 36.3%, we reject project F. Okay, so that's what we do with deciding which of the two projects are feasible. Okay, so kindly read through this, guys. Okay, capital rationing. Okay, that ends chapter 5. That's a summary of chapter 5. And then also for chapter 6, chapters 5 and chapter 6 are the chapters on capital budgeting. So chapter 6 is just all about reinforcing the concept of net present values. Okay, so I will leave that to you guys to read. Okay, so for example, here, there are 5 general rules as far as NPV is concerned. Number 1, we use cash flows and not profits. Number 2, we use incremental cash flows. Okay, we use incremental cash flows. And then number 3, we treat inflation consistently. Okay, number 4, separate investment and financial decisions. And number 5, forecast and deduct taxes. Okay, so there are some discussions about the 5 rules here. Number 1, discount cash flows and not profits. Okay, so we use cash flows and not profits. Okay, so rule number 2 is discount incremental cash flows. What do you mean by incremental cash flows? When you say incremental cash flows, what you want to compute is, okay, is not to consider sunk cost. No? Sunk costs are like, as the book explains, it's like spilled milk. These are past costs and they're no longer relevant. No? They are past and irreversible outflows. Sunk costs are bygones. They cannot be affected by decision to accept or reject the project, and they should be ignored. There are some examples here, guys. Some examples which you may look at. Okay, then inflation, not so much. We will not be dealing with inflation so much. Okay, then separate investment and financing decision, and then of course you have to remove taxes. Okay, for chapter 6, not so much, guys, since this involved taxes. We're not going to discuss so much taxes as far as capital budgeting is concerned. Okay, what I would like to point out here is that when we take a look at cash flows, there are 3 elements to the cash flows. Number 1 is cash flow from the capital investment. This is the initial investment. Number 2, the cash flow from the operations. And number 3, the changes in the working capital. Those are the 3 important cash outlays. So capital investment, and then operating cash flows, and then the investment in working capital. So there's an example here. Okay, so here you'd like to see, this is an investment, IMC's Guano project. So what are the cash flows involved? Part A is capital investment. Okay, so first is investment in fixed assets. Okay, so the company is going to invest in the fixed assets. And then if there's any sale of existing fixed asset, that has to be considered, and any tax on the sale that has to be considered. So the capital investment is negative 12,000 outflow. So this is the first cash flow to consider. Secondly is operating cash flow. So you can see here that we project revenues for year 1 up to year I think this is year, whatever year. Year number 6. Okay. So you forecast the income statement. You forecast the income statement. Okay. And then you get the profit. Okay. You get the profit. And then this will be converted into cash flow. So you take note, guys, after coming up with the pro forma income statement or the projected income statement, the income statement is converted into cash flows. And how is it converted? Usually by adding non-cash expenses, in this case, depreciation. Okay, so you now have this operating cash flow, and then you also take a look at the working capital, the investment in working capital. Okay, then you combine all of these three. Okay, you combine all of these three, so you now have this. This is now your project cash flows. Okay, take note, it's the projected cash flows by adding the initial investment, the operating cash flow, and then the investment in working capital. And then after that, you compute for the discounted cash flow, which means you take the present values and then compute for the net present value. So in this case, the net present value is positive then, which means that this project is feasible since the net present value is greater than 0 or positive. Okay, so that in a nutshell, guys, is how we evaluate projects, how we come up with the cash flows, project cash flows. So 3 steps: capital investment, operating cash flows, and the investment in working capital. So those are the 3 basic components of your cash flows. Okay, so my explanation on dito. And then after all of these are added, summed up, then you're able now to determine if a project is feasible or not. Okay, and then we have this. We said that we use the net present value as the basis for determining whether the project is feasible or not. Okay, so that's chapter 6, guys. What's important there is the components of the cash flows. So in a nutshell, guys, in just around 20 minutes, we were able to summarize what chapters 5 and chapter 6 is all about. So this will be included in your quiz this coming Saturday. So it will include capital budgeting and cost of capital, which we will be discussing on Wednesday. Okay, any questions about the 2 chapters, guys? Clear ba so far yung discussion natin dun sa, of course, guys, I would encourage you to read the text. No? Okay, may I now invite you to open the Excel file that I asked you to open. Okay, once you have it open, guys, could you kindly chat so that I know you already have access to the file? Let's start with the first worksheet, NPV, IRR, and MIRR basics. Kyron, could you kindly share your question to everyone? what do you mean by previous topic?
Ano po sir, yung mga present values and the future values?
Yeah, similar. We'll be using that. No? Kaya mas madali na yung discussion natin sa NPV.
Sige po sir.
Thank you. Okay, does everyone have the file? Okay, so let's start. Kyron is correct. This is similar to what we discussed before. So this is just a, as far as the computation of NPV, IRR, this will be a breeze for us kasi na-discuss naman natin ito before. No? So, okay, so once again, guys, how do we evaluate capital budgeting projects? Okay, of course, first of all, we have to have the projected cash flows. So these cash flows, guys, negative 1.2 at year 0, and then this other cash flows from years 1 to 5 were computed using the 3 steps that we identified a while ago. First, you have to identify you have to compute the capital investment. How much is that investment worth? So it could be an equipment, buying a new equipment, or buying a real estate, or buying a business, okay? So, etc., depending on the project that a company would like to invest in. And then the cash flows for operating cash flows has to be computed. So how are these computed? The company prepares a forecast of their income statement. So what are the expected revenues? What are the expected costs? Etc. So they come up with an income statement, and then the income statement is then converted into cash flows. So these cash flows are the ones here now. So yung 3 steps na yun, guys, the initial investment, the operating cash flows, and the investment in working capital. So once they're computed, they're combined, so we have this final product already. Okay, so how do we determine whether this project is feasible or not? If you recall, guys, we have to convert all of these cash flows into present values because we cannot add them. So we're given that the weighted average cost of capital is 12.6%. So let's give this a name. Okay, let's give this a name for easier access. Okay, I'm going to name this WACC. WACC, okay? So this now has a name, weighted average cost of capital. Okay, then if you recall, guys, we have to compute for the present values. So the long cut is, if you recall, we get the negative present value. The rate is your WACC, okay? The NPER is, this is year 0, okay? There's no PMT. And the future value is your cash flow. So we ignore the type because this is not an annuity. Control Enter. Okay. As expected, the present value is 1.2 million is 1.2 million. Copy that to the right. Okay. So now we have converted our cash flows into present values. Okay. 420,000 in 1 year's time is equivalent to 373 now. If the rate is 12.6%. So these are now present values, so we can now add them, okay, sum them up. Okay, so we have a net present value of 159,856. Okay, so is this project feasible or not? Yes, this project is feasible because the net present value of project Y is positive. It's greater than 0. Okay, so this is the long way to do it, guys. But we learned before that there's a shortcut for this. Just get the NPV. So we'll just use the net present value function of Excel. However, okay, the rate is still WACC. However, guys, recall that NPV function of Excel uses future cash flows. Therefore, we have to highlight these future cash flows, okay, and then just add back the initial investment. This one. Okay, we do not include 1, 2 in the cash flows, in the values, because if we include 1.2 million, then we are telling Excel that this 1.2 million will be for the first year. Okay, because the NPV function uses future cash flows. Okay, enter there. All right, so the same, guys. So we'd like to just use the NPV function for computation. Okay, kasi mas mabilis, ano? Control 1. Before sa hindi ko nalagyan ng decimal place na lang. Okay, I won't put any decimal place. All right. So sabi natin, ang decision rule, guys, if the net present value is positive, then the project is acceptable. Okay, then let's do that for project Z. Okay, so the same formula is equal to negative PV. Then the rate is your WACC. Okay, your NPR is this amount, 0, no PMT, and then future value is your 1.8 million. Just the same formula as above. Okay, so we now have the present values. So 900,000 after 5 years, in 5 years time, is equivalent to 497,000 now, assuming the rate of return is 12.6%. So we can add these figures now. Okay. And just one formula, NPV, where your rate is your WACC, and then your values. Again, start with okay, don't use, guys, the present values. Okay, kinumputa natin yan. Plus the initial investment. So the same, 244,638. Okay, let me pause for a while, guys, and kindly chat, please, if you have computed for the net present values of project Y and project Z. Kindly chat, please. Okay, good, thank you. Okay, so based on these cash flows and the net present value, which of these projects are feasible? So it depends, guys. If the projects are independent, then okay, both projects can be done by the company, assuming that the company has sufficient funds. Let's say they have 3 million available, then they can push through with project Y and project Z, because the initial investment requires a total of 3 million. If that's not a constraint limitation, then they can push through with project Y and project Z. However, if the projects are mutually exclusive, then there should only be one choice, and that turns out to be project Z. Okay, so project Z is the chosen project by virtue of having the higher net present value. Okay, now we take a look at profitability index. So default na naman sa malaking decimal. Okay. Now, what's the profitability index about? The profitability index tells us a per peso comparison of our projects. Okay, so let's compute this. So the formula for your profitability index is simply, okay, so this is the net present value, right? This is the net present value divided by your initial investment. So so we have to get the present value of the inflows. Okay, if you take a look at this, Okay, apology. It's not the net present value. If you take a look at this formula, guys, it's the cash flows discounted from t is equal to 1 to t is equal to n. So what we are interested in is the present value of our cash flows. So where do we get that? Okay, we can get that here. Here, right? So this is the present value of all our operating cash flows. So let's get that here. Sum of, for project Y, it's this one. And then for project Z, it's the sum of and then we know that the present value of our investment is this one. Okay, for project Y, it's 1, 2. I'm removing the negative. Okay, and then we just get the ratio of your present value of your inflows divided by your outflows. You can just copy this formula. Okay. So based on the profitability index, which is a measure of the present value inflows per unit outflows. So for example, this is 1.133. For every 1 peso of cash flow invested in project Y, it will yield a 1.133 pesos inflow. Okay. For project Z, it's 1.136 inflow. So project Z is the better project based on profitability index. Okay, since it has the higher profitability index. Okay, again, what's important, guys, is how we compute for the profitability index. So you add all your cash flows. Of course, don't include the initial investment, and then compare the sum of this cash flows with the initial investment by getting the ratio. Okay, in this case, project Z is better because it has the higher profitability index. Okay, is that clear, guys? Paki-chat naman please kung clear yung concept ng profitability index. Okay, thank you. Thank you. Good. Okay, thank you for your feedback, guys. All right. Okay, let's move on. IRR, we know this already. In fact, we have computed this before. Okay, so let's just let's just compute for the IRR of project Y. So I'll put it here. So no need for this. We're not going to do the manual computation of IRR. We'll just use the function IRR. So this is equal to IRR. And for IRR, you get all the cash flows of project Y. Okay, there. So I highlighted all the cash flows of project Y. Okay, and ignore the guess. So let's make this %. Okay, so the IRR of project Y is 18.23. Okay. Now, if you compute, guys, for the NPV of project Y, when the cost of capital is equal to your IRR. Okay, so let's just show that. Okay, so take a look at this formula, guys. So what are we doing here? We're computing for the NPV at the IRR of project Y. And what do you get there? Okay, so the NPV of project Y, based on the weighted average cost of capital that's equal to your IRR will be 0. Diba sabi natin yan, diba? The NPV, the net present value, is the NPV is the IRR is that rate of return where your net present value is equal to 0. And the same thing for project Z, guys. For project Z, this is equal to IRR. So let's make use of the cash flows of project Z. This one. Let's copy this format. There. So it's 17.39. Okay. And let's copy this. Oops. So this should be NPV, this one. And what are the values? Values natin, guys, yung mga from years 1 up to years 5 plus the initial investment. Okay, you also have 0. Okay, so let me pause for a while and give you time to compute for the IRR and the NPV. If the weighted WACC was equal to the IRR. And I got Z error for project Z. Anong sa project Z ano? Ed, is it the IRR or the NPV? Ed, could you unmute yourself kung pwede? Okay, thank you, Ed. Okay, guys, kindly feedback, please, if you got the IRR. Thank you. How about the rest, guys? Thank you, Aaron. Good. Waiting for the others, guys. Feedback, please. Okay, good. Diana, thank you. The rest? Justin, salamat. Some more, guys. Let's wait for some more responses. Okay, thank you, Julian. Okay, now I wrote here some conclusions based on IRR, which is the better project. Okay, first, is project Y acceptable based on IRR? Yes, because the IRR of project Y, 18.23%, is greater than the weighted average cost of capital of the firm. Okay, yung average cost ng capital ng firm, 12.6, mas mataas yung IRR ng project. So okay siya. No? Okay siya. Ganun din si Project Z, 17.39% yung IRR. Okay? So based on the IRR, guys, if we compare Project Y and Z, turns out that Project Y is better. Kasi mas mataas yung IRR niya. Diba? Project Y is better than Project Z. Since the IRR of Project Y is greater than the IRR of Project Z, which runs in conflict with NPV natin. Kasi sa NPV natin, Project Z is to be chosen because it has the higher IRR. NPV. So in instances like this, when your NPV and your IRR conflict, the decision rule is follow the NPV. No? Follow the NPV. So mas pipiliin natin si Project Z if these projects are mutually exclusive. Bakit? Because we answered before that theoretically, mas tama yung pag-compute ng NPV as compared to IRR. Because when you compute for the IRR, there are certain assumptions that are quite restrictive. Okay, but we will not go into the details of that. No? What's important is that the NPV is the far superior method than the IRR. Kaya nga meron tayong tinatawag na MIRR. Okay? So let's compute for the MIRR. Is equal to MIRR, modified internal rate of return. And returns internal rate of return considering both the cost of investment and the investment of or reinvestment of cash. Okay, so let's do this. Ang values natin for project Y, di ba ito? Then comma. So this is where it gets a bit tricky, no? Yung mga assumptions dito. The finance rate is WACC. And then comma, the investment rate is WACC also. Okay. So dito nagkakaiba si modified at saka si IRR. Kasi kay IRR, okay, di ba tinatanong dito reinvestment rate? Kay IRR, the reinvestment rate is IRR. Okay, so medyo nakakalito, no? Kay MIRR naman, ang reinvestment rate is still WACC. Okay, but we will not delve into the, let's say, the nitty-gritty nuances of that. Okay, what's important, guys, is that kaya nga they came up with this modified internal rate of return. It's because this is the more correct way to compute the rate of return. No? So Control Enter. So let's just copy natin yung format. Okay, so the MIRR for project Y is 15.45%. Okay, and the MIRR for project Z is values again. Values. Okay, and then finance rate is the WACC, the investment rate is the WACC. Okay. Formula. Okay, so you can see here, guys, that based on MIRR, no, mas mataas yung MIRR ni project Z, yung modified internal rate of return as compared to project Y. So since project Z has the higher MIRR, then we can say that indeed project Z is the better project compared to project Y. Okay, guys, clear ba? Clear so far? Any questions about the computation for MIRR? Of course, you can compute also for the NPV. No? Control C. You can compute the NPV based on Okay, so what did I do, guys? I computed for the net present value of Y if we're using the MIRR. And this is the net present value of Z if we're using the MIRR. It turns out, guys, that based on the modified internal rate of return, the net present value of project Z is really better. Okay. All right. Any questions, guys, about MIRR? So that's the modified internal rate of return. And normally we get that if there's a conflict between your NPV and your IRR. And always, guys, your MIRR will always agree with your NPV. It will reinforce the NPV decision. Okay, questions? Clear so far, guys? Clear? No questions? Okay. All right. The last two are the payback and the discounted payback. Sabi natin, guys, itong payback period, ang weakness nito, it does not consider the time value of money. Kasi ang ina-add natin dito, yung mga original cash flows. Okay, so we add the original cash flows in order to determine the payback. So which is, sabi natin, it violates the time value of money principle kasi actually hindi naman natin pwedeng i-add itong mga to kasi they belong to different time frames. Okay, so let's first complete for the cumulative payback. So there's this good, very simple but very powerful formula. If you want, for example, to add 1, 2 to 420, and then 1, 2 to 420 to 480, tapos parang i-accumulate natin mga cash flows natin until year 5, then we can sum up starting with this one and then press colon. When you press colon, guys, uulitin si B93. Tapos punta tayo dito sa first one and we can just fix column B. No? Column B, because we're going to copy this along the row, so no need to fix row 93. No? We're just going to fix column B. Okay, so control enter there, and then we copy to the right. Okay, anong nangyayari, guys? Ina-add natin yung mga cash flows natin on a yearly basis. No? Okay, so notice, guys, na naka-fix sa 1, 2. When we copy to the right, dinadagdag every year na sinasama natin sa range ng idadagdag natin. Alright? So, what does this mean? At year 1, guys, we were able to recover already 420 of our initial investment. So, ang kulang pa natin, 780. At year 2, okay, naka-recover ulit tayo ng 480. So, kulang na lang natin 300,000. Pagdating ng year 3, guys, positive na. No? Ibig sabihin, na-recover na natin lahat ng 1, 2 natin. Okay, in fact, sobra na tayo. Okay, so how do we compute for the payback period? We will assume that the cash flows is generated uniformly throughout the year. Okay, so ibig sabihin yan, when is the cash flow? So nasa ano siya, nasa nexus ng naging from negative to positive na yung cumulative cash flow natin. So it's equal to 2 plus, okay, 2 plus ano? 2 years plus, okay, at the end of the year 2, ilan ba yung kailangan pa natin i-recover? Di ba 200 pa? 300 pa yung kailangan natin i-recover at the end of year 2. Ilan yung makukuha natin sa year 3? 320. You know, 320. So, at the end of year 2, we need to recover 300. Okay? At year 3, guys, ang makukuha natin 320. Therefore, okay, we'll just get the ratio. I'm going to put here a negative 300 and then divide it by kung magkano yung marirecover na 320. So, pinaportion ko lang si 300,000 out of the 320 na makukuha natin at year 3. Control Enter. So, approximately mga 2.94 years, 2.9 years. That's the payback for project Y. For project Z, pwede natin copy ito, Control C, Control V, and then copy to the right. There. So, ina-add din natin yung mga cash flows natin, ano? So, ang payback natin dito, kailan magiging positive na? Kailan natin marirecover yung cash flow natin? Year 4. Year 3, there. Year 3 plus, okay, how much do we need to recover? 410. Ine-negative ko to para maging positive siya. Divided by the cash flow expected at year 4, it's 710. Okay, so this is 3.58. Okay, so all this is saying is that we'll be able to recover our 1.2 million at 2.94 years. Ito naman 3.58. Okay, so dito masasabi lang natin na mas mabilis natin marirecover si project Y. That's understandable kasi nga mas malaki yung initial investment niya. Okay? Any questions, guys, about the payback period? Okay, thank you. How about, guys, paki-chat kung clear so far to. Kung nakuha niyo yung payback period. Paki-yes na lang, no? Okay, thank you, Justin. Thank you, Ed. Clear ba so far, guys, yung payback period? Can you chat, please? Guys, okay na ba? Okay, I'll assume na no questions. All right, lastly, guys, on discounted payback. Okay, so the discounted payback is quote-unquote better than the payback period. No? Kasi ang weakness ng payback period, you're considering the original cash flows, you're adding them, and it will violate the violates the time value of money principle kasi ina-add natin yung mga cash flows that belong to different time frames. Ang discounted payback period naman, as the name suggests, discounted cash flows ang ginagamit. So, here we go back to what we were, yung kinumpute natin kanina, WACC. Okay, actually, guys, pwede natin i-link na lang dito sa PV natin dito. Okay, so let me link it here. There. So, kinuha ko lang yung mga present values ng cash flows natin. And then copy to the right. Okay, di ba na-complete na natin itong mga present values? Okay, and then this is the one that we're going to use. No? Ang gagamitin natin na accumulate yung mga present values. Okay, so let me just copy this. Kasi itong formula to, naka-base lang sa taas. Control C, Control V. Okay, and then get the cumulative cash flows. So, ang discounted payback period natin will be between year 4 and year 5. So, that's year 4 plus negative, ito yung kailangan pa natin ma-recover, divided by magkano yung cash flows na makukuha natin, this amount. Yung ano din yung present values din. No? So that's around 4.2 years. And then for this one, we've also copied the present value for project Z. Okay. So again, guys, the only difference between the payback period and the discounted payback period is that sa discounted payback period, ang ginagamit natin yung mga present values. Samantalang sa payback, ang ginagamit yung original cash flows. And sabi natin, may mali doon kasi ina-add natin yung mga original cash flows na hindi naman pwedeng i-add kasi they belong to different time frames. Ito, mga present values na to, so pwede nang pwede nang i-add, no? So once again, cumulative natin yung cash flows natin. So this is equal to 4 years plus how much is still required? This one divided by, makukuha natin 497. Okay. Okay. So simple lang guys yung payback period, no? Ang difference lang nila, sa payback period ang ginagamit natin yung original cash flow. Sa discounted payback ang ginagamit natin yung discounted na values. And which is the more correct way to compute yung discounted payback. Kasi sa discounted payback ang ina-add up natin yung mga present values. Okay? All right. Clear ba so far guys yung payback at saka discounted payback? Paki-chat naman please. Any questions? Paki-chat naman please kung clear so far. Would appreciate guys feedback from you so that we can continue our discussion. Isa pa lang guys ang feedback. I hope others will give their feedback. Let's wait for the others to. Okay, good. Thank you so much. Thank you for your responses. Let's give a few more seconds for your classmates. I hope all of you are able to follow along. Okay, good. All right. So reality check. We have mga 20 more minutes. Okay, pero we have three more worksheets here. Okay, let's quickly do this unequal lives. Okay, yung unequal lives, guys. Okay, if we take a look at this, how do we choose now which is the best project here? Magkakaiba yung lives sila, no? They have different lives. So parang unfair para sa kunyari project D. Kasi si project D, guys, 8 years yung lives niya. So, di ba, parang lalabas na mas malaking cash flow to, no? Okay, so let's first compute for the net present value. NPV, okay. Ang rate natin, 12%. No? So we can just, we didn't need not fix this kasi meron naman 12% sa lahat. Comma. Remember our values, guys. Dapat magsisimula sa year 1, no? And hinilay ko lang lahat para makopy natin to the right. And then we have to add the initial investment. Okay, so that's how we get the net present value, di ba? Yung rate natin, we don't need to fix this kasi kakopy lang naman natin sa right. Meron naman mga 12% dito. No? Okay, so Control Enter. Copy to the right. Okay, turns out, guys, that Project D, the best project based on NPV, guys, pinakamaganda si Project D. Kaso, guys, take note that hindi naman natin actually pwede i-compare yan kasi magkakaiba silang time frame. Okay sana, guys, kung pare-parehong time frame yan. Then no problem with the choice. But since they're different, guys. We cannot say that Project D is really the best. Okay, so we need to do something about this. We need to compute for the annualized NPV. How do we compute for the annualized NPV? We need to compute for the annualized NPV by getting the present value interest factor of an annuity. Okay, so what's that? Ano tong PVIFA na to? Okay, for example, si Project A, no? So meron siyang 0, 1, 2, 3, 4, 5, 6. But 6 years siya, no? Si Project A. So what we need to do is compute for the present value interest factor of an annuity. Ibig sabihin, meron tayong annuity ng 1. Okay, if you recall annuity, guys, uniform stream of cash flows. Meron tayong annuity ng 1, tapos kunin natin yung present value nito. So what's the present value of this? Anong present value ng 11111 for the next 6 years? 1, 2, 3, 4, 5, 6. No? Ano yung present value niya? Okay, so let's compute for that. It's equal to negative PV, present value. Ang rate natin 12%, comma, NPV natin, di ba, 6, comma, PMT natin is 1. Di ba 1? Kasi annuity yan eh. Okay, and then walang future value. Okay, yan. All right, so it's 4.11. So it's 4.11, guys. Ito yung present value ng annuity of 1 for 6 years. Okay, so ito yung gagamitin natin na divisor. Okay, for Project A with NPV of 60.693. So what we're going to do is i-annualize natin yung net present value natin by dividing everything by the present value interest factor of an annuity of 1. Okay, so let's compute this for all the investment. This is equal to negative PV. Ang rate natin, guys, is 12%. Okay, di ba? Kama. Ano yung NPV natin? Ito yung problema natin kasi magkakaiba silang magkakaiba silang mga years. Itong isa, hindi naman natin pwedeng gawing 6 kasi yung susunod 4 na lang, yung isa 5, yung isa 8. Okay, so we have to use a formula. What we can use is count A. No? Ano yung count A? Papabilangin natin yung mga non-empty. No? So highlight natin to. This one. No. 1, 2, 3, 4, 5, 6. Okay. That one. Then comma. PMT is 1, di ba? And then ignore the future value and ignore the type. Okay, so take a look at this formula. And then copy to the right natin to. Pinapahanap natin kay Excel yung present value. So this is the rate. This is the NPV. This is the PMT, no? PMT. And then ignore the future value kasi wala namang future value. Annuity of 1 yan. And then ignore the type kasi ang assumption lagi niyan is ordinary annuity. Control Enter. Yan, tama, no? For 11. So i-copy natin to the right to. Yan. Let's check our formulas. Okay. So ito ilan to? Tama, no? 1, 2, 3, 4. Annuity of 4. Okay, so we have the correct formula. No? We have the correct formula. So this is the present value annuity factor for this cash flow. 4 years lang kasi siya. Ito, 5 years. Ito, 8 years. So you notice na yung present value interest factor is bigger, guys, kung mas maraming years. No? Now, to get the annualized, i-divide lang natin to. This divided by this. Okay. There, guys. So, based on the annualized net present value, it's project B that's the best. Yan. Annualized siya. No? Annualized net present value. You cannot use this. You cannot use the NPVs, guys, to compare the projects because they have different time frames. Kung magkakapareho lang ng time frames yan, din okay. Kung pare-parehong cash flows, no? Ng 8 years. Panalo si project D. But because they're different terms, then we have to annualize them, guys, by computing for the present value interest factor of an annuity of 1, and then divide natin, and then these are now the annualized net present value. Okay? Once again, guys, paki-chat naman please kung clear. Medyo I will request you to please respond quickly kasi medyo kulang na tayo sa oras. Any questions? Clear ba so far yung yung how to do it if it's if the lives are unequal? Okay, thank you. A few more seconds for the rest. Comment. Okay, good. Thank you so much. All right, we move on to this one. So we have 2 more worksheets. Okay. Now, I said a while ago that if a project has usually, syempre, negative yung initial cash flow kasi maglalabas ng pera dyan. And then sometimes there may be a negative cash flow in between the beginning and the end or at the end mismo. No? So pag ganyan, guys, most probably, guys, dalawa yung IRR niyan. Okay, so how do we compute for the IRR? First, guys, IRR. We know that the IRR is the values, diba ito? We highlight the values and then guess, ignore the guess. Okay, so this is the first IRR, no? 3.91. So how do we get the second IRR? So this is trial and error. Okay, dito papasok yung guess, guys, no? So this gave us the lowest IRR, so possibly may isa pa. If I try, kunyari, guess 10%, so yung sa guess, guys, just put any other number higher than 3.91. So dito sinubukan ko 10%. So hindi natin nakuha, no? So let me increase this. Gawin kong, what if I make this 15%? Okay, there. Nakuha na natin, no? So ito yung dalawang IRR, guys, no? These are the 2 IRRs. Insert muna ako dito. The first IRR is 3.91. The second IRR is 30.28%. No? And we can plot that. We can plot yung WACC natin at saka yung IRR natin. No? Okay, first let's list down WACC from 0%. Gawin natin from 0% up to 40%. So let me put here 0%. Okay, tapos mag-fill na lang tayo. Fill series step value. Let's make it 2% na lang increments hanggang stop value 40%. And then I want it in columns. So what we're going to create now mga WACC from 0% hanggang 40% increment of 2%. Okay, so there you go. No? So meron na tayong WACC dito hanggang 40%. Ayan ko lang. Okay. So what we do, guys, is to insert natin to 3.91 at saka 30.28. No? So si 3.91, andito siya. So let me put a space here. So and then is equal to 3.91. Bigyan ko lang siya ng color dito. Okay. So siningit natin yung IRR1 sa WACC natin at saka IRR2 30.28, so that it should be after 30%. There. 30.28%. Right? So we inserted this, guys. We inserted this 0%. Okay, and then what do we do? Okay, we can compute for the net present value, NPV, using this rate, NPV, this rate, comma, values natin. Okay, then we have to fix that. Fix natin yung rows. Kasi ikakopy natin pababa ito. And then plus this one, fix the row. So we're just computing for the net present value of this cash flows if the WACC is 0%. Control Enter. Lakihan ko lang. Okay. And then we can copy this down. There. Okay. Take note, guys, that yung mga IRRs natin, it's where your NPV is equal to 0. So dito 0 siya, tapos din dito 0 din siya. Okay, so what we have done is to come up with a list of computation of NPV given different WACCs. Sinama natin yung WACC na 3.91 at saka 30.28. And as expected, yung NPV ng 3.91 is 0. Diba? Kasi that's what IRR means. Eh. An IRR is that rate of return where your net present value is equal to 0. Ganun din tong 30.28. No? IRR siya, 0 din siya. So pwede natin i-plot to. So let's just show this plot. Okay, insert. Okay, ito na lang. There. Okay, dito guys yung multiple IRRs natin. No? If you take a look at this is 3.91 ito, and this is 30.28. So those are the two IRRs where your net present value is equal to 0. Okay, so what can we conclude here? Between 3.91% up to 30.28%, okay, if the weighted average cost of capital is between those two, then okay yung project, no? Kasi yung mga NPV sila positive. Pero below 3.1% and higher than 30.28%, okay, then we don't push through with the project. Kasi the project will only be feasible for those where the net present value is positive. No? Diba? So ang positive na NPV natin dito sa area na to, from 3.91 to 30.28. Higher than 30.28, negative na NPV. Lower than 3.91, negative na NPV. Okay? Okay, naku, tapos na tayo sa oras. Okay, any questions about this one, guys? Okay, ganito guys ha. Dito sa last I'll just keep on recording until matapos to. The rest of you, if you need to go, you may do so. Tapos ipopost ko na lang to guys sa ipopost ko na lang sa ipopost ko eh. Kasi mabibitin tayo. Konti na lang naman to. No? And we have only around 5 minutes na lang left. Alright, so sa huli guys, again, we're going to compare Project S and Project L. Okay? Project Small and Project L, given their cash flows. The WACC is at 10%. So lagyan natin ng pangalan to. WAC 1. Kasi may WAC na tayo kanina, no? WAC 1 na to. So let's compute for the NPV ng project S. So that's the rate, WAC 1, and then comma. Values natin should be from year 1, okay, and then plus the year 0. So 78.82 for project S, and then copy this to the right. 100.4 si project L. Okay, how about IRR? IRR, values natin lahat. Okay, straightforward. Okay, 13.5. So in terms of NPV, okay si project L, di ba? But in terms of IRR, mas maganda si project S. Again, yung conflict na ganyan, sabi natin, let's resolve easily by MIRR. Okay. Values, same thing. Finance rate is WAC 1. Okay. And then investment rate, WAC 1 din. So pareho lang kapag IRR. Control Enter. Okay, there. Alright. So MIRR, mas maganda si Project L. IRR, mas maganda si Project S. NPV, mas maganda si Project L. So alam natin na Project L is to be chosen. Kaso guys, sabi natin kanina, yung pinakita kong ano sa inyo kanina, yung diagram. Yeah, go ahead guys, go ahead. So, we need to compute for the indifference point. Yung indifference point guys is that point where we don't mind whether it's Project S or Project L. So let me compute for that. Okay, so let me compute for NPV. Compute natin si NPV. Ang gagamitin natin na rate ito. We don't know what that rate is. Then comma. Yung mga values ni Project S ito. Plus this one. Okay. Control Enter. Okay. So we get the difference between the NPV of Project S and Project L. Okay? So ang ginagawa natin guys dito, papahanapin natin kay Excel to, ano tong indifference point na to? Ano tong IRR na to na pareho lang silang NPV, no? Okay, so how do we compute for that? Okay, we will compute for that if you recall using data and then what if analysis and then goal seek. Okay, ano yung goal seek natin? Okay, set cell, this one, yung difference to be equal to 0. Okay? So dapat yung difference itong NPV ni S at saka ni NPV ni L, dapat 0 siya by changing this cell. There. Okay. So it turns out that yung indifference point natin 11.975%. Okay? So let's now generate mga WAC na from 0%, lalagay ulit tayo ng hanggang 30% na lang. So from this one, okay, home, fill series, column, increment of 1% hanggang 30%. Okay, there. No? Kasi i-compute natin yung NPV at saka NPV sila. So what we're going to do here is insert natin itong mga points na to. IRR, MIRR at saka itong indifference point natin. So first, itong indifference point natin 11.975. Okay, so dito I'm going to insert this is equal to 11.975%. Yun, no? So pinapasok natin yung mga ibang and then 12.1 and 12.7, pasok natin sila. Dalawa to is equal to 12.1%. Okay. natin ng ano to para alam natin na 12.1. This is equal to 12.7%. Lalagyan ko lang to ng ano This is MIRR ni Y, MIRR ni Z. Ito yung indifference na point. Indifference. Tapos, ito na lang, 13.5. Sama natin dito si 13.5. This is equal to 13.5%. So this is IRR ni Z. And lastly, 14.5%. So that's after 14%. Guys, again, you may go now. No? Tapusin ko lang itong pag-record nito para 14.5% there. This is the IRR of Y. Okay. All right. Then we're now ready to is equal to kunin natin project S dito. Link natin dito. Project L, link natin dito. Okay, we're now ready to ask Excel to fill this up. Okay, papa-fill up pa natin ng mga NPVs, no? Mga NPV to. So how do you do this? Data, what if analysis, and then data table. So we use data table. Now, sasabihin natin kay Excel na fill up pa niya itong mga columns na to. So this one, column input. So ano yung column input, guys? Itong mga weights na to, no? Dito ipapasok. So mangyayari, papalitan niyo to na 0%, 1%, etc. And then kukunin niya yung values ng NPV na to. Okay? Alright. So we now have this. Okay. Tapos guys, paki-unhide na lang. Unhide, meron diyang crossover 1. There. Okay, so ito plinat ko na. I plotted this. Okay, tapos ito na yung discussion, no? This is now the discussion, yung mga indifference point natin. So this is what we call the Npv profile. Okay, the blue one is project L. The brown one is project S. And you can see, guys, na nagbabago-bago yung decision natin, ano? Okay. The decision will be based on, okay, so saang anong WAC, no? So below 11.97%, always choose project L. Greater than 11.97% hanggang 14.49%, choose project S. Otherwise, beyond 14.97%, okay, wala ka nang pipiliin sa dalawa. Tapos we're indifferent dun sa 11.97%. It doesn't matter whether you choose project L or project S. Okay? So that ends our discussion, guys, on this one. So I will stop recording now. Stop recording.